5:46, the 11th August, 2020. Please like, share, and subscribe. Okay, ladies and gentlemen, hate to sigh directly into the microphone, but there are just some analysts, some statistical analysts that know their game, and when they talk, people sit down and listen. Jim Willie is one of these guys, and I would like to talk about current market conditions and the pre-market, whatever, futures. Futures are up. There's no, as Greg Vanarino would say, let me see your shock face. Okay. But as we profit off of this, we have to be mindful of the next move. We know that the politicians, big money, and the American people, the ignorance of the American people, that trifecta is most certainly going to be the demise of the United States. The ignorance of the American people to refuse to really see what's going on. The brashness of the politicians and of the financiers, the Federal Reserve, to take advantage of these sheeple, and the willingness of these sheeple to be taken advantage of. What else would you expect to happen? My main goal here is with Social Security at zero funding, corporations being allowed to keep the FICA insurance and do whatever they wish with it. Um, it's and the fact that it has to be paid back on December if Trump gets reelected, or it doesn't have to be paid back, or maybe it never needs to be paid back, is a death knell in the projected 2030 collapse of Social Security. Pre collapse, Wall Street will get its hands on what's left before it collapses, and they will put those Social Security funds in the stock market. That will be the final move in the total castration of the American middle class. There's nothing you can do about that. There's no voting for this Democrat, Republican that's going to stop this. Forget it. We're here right now. As I tell these, sometimes, just because we support police, military, that doesn't automatically make you a patriot. It's how you honor the living, not the dead. That's coming from a Christian perspective. That's what Christ said. But you consistently honor the dead because you don't have enough brain power to honor the living. You don't have enough honor yourself to honor the living. You're consistently honoring things that cannot benefit from your energy. If it's subprime loans for cars or houses or taking a tax cut that is defunding Social Security accounts, or if it's collecting unemployment when you definitely could go out there and work. Let's get with the stock account right now. What I've done here is amassed some stocks that will do well under the conditions of a weak dollar, aka transitioning dollar. Um, because, like Jim Willie said, and it makes total sense, they say the dollar is weakening. Well, relative to what? What is getting stronger? Well, that would be the euro is getting stronger. So, what I've been displaying here and talking about for such a long time is recently been put on the back burner, and I would like to revisit BNDX, BNDW. Each one of these subprime bonds derivatives reflect the U.S. Japanese yen currency regime and the U.S. dollar euro currency regime. BNDX is a sister of BNDW. One is a representation of a euro dollar currency regime world pan American view, and BNDX is a Japanese yen US dollar currency regime sphere of influence or um, pan worldview. It's worldview. Pan view. Japan is the largest holder of U.S. debt, treasuries. As you can see, BNDX is in the positive. Europe is consistently dumping U.S. debt, and that is a definite sign. That Europe is dumping U.S. debt and accepting Chinese debt, which is strengthening the euro. They've switched sides. I use BNDX, BNDW as strictly a shelter when the market is extremely volatile and I don't want to take my money all the way out. And from that point, First Trust Preferred, FPE, is going to be a remedy for the joke that these currency regimes have become. Not that I won't move buy shares of these stuff BNDX, BNDW, but it's not going to be first rodeo. It's not. It may be one of my last rodeos with them. This is 37.05. 1% cash. 0.03 stock. Net assets 5.02 hundredths of billions. Um, and I would like to get into it more while we're looking. I haven't had opportunity. I've had brief opportunities to look at this. There are no comments on any of these. That's how I know I'm breaking extremely new ground with this. And we're talking about certified exchange funds, evaluating open end fund alternatives. Uh, you're reading along with me, I hope. And I'll go ahead and read for you. Summary: the sharp market rally since March, as well as the risk of second wave, may be prompting some investors to consider options to de-risk their portfolio. One way investors can do this is to partially reallocate from EFs into OEFs, which tend to boast lower drawdowns and volatility. I've already partially done this with UCO, which is a fixed income oil derivative, and that's why I've been seeing real good stability in my portfolio. I want to continue this trend with the stock that we're speaking about right now. We take a look at open end funds in preferreds sector, focusing particularly on ETFs. Our main takeaway is to avoid large AUM, assets under management, ETFs such as PFF. Consider allocating to individual. That's what we're talking about here. Preferreds. I don't know what that is really. I have to really. I'm gonna have to. I'm coming back to this. This is just raw, uncut, late, early in the morning, talking with my audience, as well as actively managed funds. Looking for a portfolio of ideas like this one, members of systematic income get exclusive access to our model portfolio. Start today. I really don't like that. With the market powering ahead and a very strong rally since March, drawdowns from investors may be looking to take some chips off the table. In this article, we take a look at open-end funds alternatives to closed-end funds. And preferreds, whatever that means, sector, open-end funds have tended to exhibit about half the drawdowns of CEFs, so they offer a safer alternative without leaving the market or going into cash. Our main takeaways are that first, the popular iShares Preferred and Income Securities ETF, PFF, has likely become too big, inflated, causing it to be a consistent underperformer in the preferreds. I gotta get the computer to sound that out for me. You have to excuse me on that because I'm not sure how to say that. And we're gonna have to, and that's actually a sector. So yeah, time to do some research. Definitely preferreds sector. Secondly, investing may want to consider allocating to individual preferreds, particularly if they want to diversify away from financials. Well, and thirdly, although the benefit of active management appears to have decreased since the financial crisis, it remains one way to avoid underperformance in the sector. An open-end active preferreds ETF that remains on our focus list is the First Trust Preferred Securities Income. This is what we're talking about here. ETF, FPE, and passive funds. We also like SPDR, Wells Fargo Preferred Stock, ETF, PSK, which is entirely investment grade, has slightly higher securities. Let's get back. Allocation to large passive ETFs. Wells Fargo Preferred Stock ETF PSK, which is entirely investment grade, has a slightly higher utility allocation than the other two large passive ETFs and has the smallest assets under management of the big three funds, which likely allows it to minimize the performance drag of its turnover activities. Risk slash reward of CEFs versus OEFs. The obvious attraction to CEFs versus OEFs is a higher yield. The charts below plot the differentials between the average CEF yields, blah blah blah, ETF benchmark. In this case, the iShares Preferred Stock Income Securities ETF currently is the differential. Currently, this differential is still relatively healthy, about 2.5, supported by lower asset prices and reduced leverage costs. If the market continues to rally, however, we can expect the differential to tighten below 2%, at which the level CEFs will become marginally less attractive. The downside of CES versus their OEF counterparts is higher drawdowns and volatility. The risk of higher volatility is exacerbated for leverage funds because of the potential need to deleverage. Deleveraging amid drawdown can lock in a permanent capital loss that leads to lower future income. The chart below shows historic drawdowns for various fund types in the preferred sector. What do I take away from this? First peek, first look. One, I need to do some research, which I will do today. Two, this trust fund, money trust, um, that we're talking about is 1.24 million. It's not inflated. If it becomes inflated, the performance will be it will be less performance if it becomes inflated. But at this point, what I'm pulling away from this is that this first trust preferred is not being tampered with. And it's not consumer market driven. Not that it won't benefit from a market that's being tampered with. But it offers an awesome alternative to dealing with BNDX, BNDW. So I expect more 52-week lows with BNDX and BNDW as things settle out after the election. Um, Once we get done with this period of superinflation, that's what I'm looking at. I'm not looking at, these aren't moves I'm going to be doing in the next couple of days. I'm going to take advantage of all of this easy money. But my question is, are you thinking about what happens after that? Another thing I like about this is the 52-week range is right there for me. 1040 to 2050, it's extremely solid. Um, Something you could buy 500 shares of and then go ahead and tear off profits within the 52-week and just keep on rolling over your principal and your dividend and maybe leaving a little extra in to allow it to grow. We're sort of at 19 right now. It's at the top of that range. Will this break the 52-week high? Could do. But mind you, as this becomes inflated because of the inflated market, then this could be not such a high performer. But mind you, a weak dollar means a stronger stock market. It means it takes more dollars to create the same volume, velocity. So what you're seeing is sort of kind of an illusion. Um, Anyways, So the bottom line with it is future play, but don't be surprised if this comes into play sooner than later. Let's move on. Okay, European company. Euro's getting stronger. I'll make this quick. ALV, New York Stock Exchange. That's where it's traded here in the U.S. They make airbags for cars, safety systems for cars. The domestic U.S. market for that kind of thing is going down the tubes, but this is in Europe. Passive active safety systems, passive safety segment, passive safety products include modules, components, passenger and driver side airbags, side impact, protection systems, seatbelt steering wheels, inflator technologies, whiplash protection systems, travel seats, and components for such systems as well as passive safety electronic products. We're talking about self-driving cars such as restraint, electronics, crash sensors, active safety, camera-based vision systems, night driving assist, automotive. We're talking a little bit of radar, a little bit of military here, brake controls. We're talking about driverless cars. Um, Company out of Europe. Let's take a closer look at what's going on with them. Another, plenty of meat on the bone, a serious ability to get long in the tooth. It's at 69. 87 is the top of the 52. Like I said, something to watch if it breaks 52 week or if it has a bad showing. Wouldn't be a bad idea to jump on this at the proper time. Yet and still, this company is going to benefit from it's a European company, strong euro. Um, Not saying that the dollar won't have days where it will spring back. There's a lot of factors in that. A lot of things can happen. A lot of executive orders can be signed to change a lot. But at least we have we know about this option here. Okay, let's continue on. See if I've added nothing there. Oh, well, I added, this has nothing to do with what we're speaking about, but I did add NAACP has a stock here and has nothing to do with what I'm talking about. I added it some months ago, thinking that the racial tensions and stuff might drive the stock higher, and we have high racial tensions, and we got $3 off of its 52-week high. Imagine that. These are my place. This is where I'm at right now, and we're going to talk about UBS and a few other ones. Did I add anything here? That's a negative. No. Going into what's going on, basically, while we're here, pit stop here, talking about currencies. The dollar was propped up, while the rest of the world could not prop their currency up. Now it's getting to the point to where the dollar, they're struggling to prop it up because other countries are pulling their backing out of the dollar, backing their own currencies. in hopes of being able to back it up with their own gold. The U.S. dollar needing to be weak in order to keep the stock market and the economy going, along with all of the stimulus, is going to end up bad, and the whole world knows it. So while the world has dealt with issues of virus and everything far better than we have, I still want to ask you, would it have been better to have public medicine like most of the world? Or, hmm, to suffer the consequences of not having a public healthcare system? I think you're seeing it now. And if I can remember the arguments from back then, one of the arguments was it would greatly help the economy if something bad were to happen. Like a pandemic, like something of this COVID nature. And everybody made fun of Mr. Barack Obama. Just putting that out there. Not that I am not apolitical. I do not give a shit anymore. And probably never did. This is about me and my money. And people subscribe to my show. Bottom line, they never gave a shit about me. Why should I trip on them? I don't believe the propaganda. Nevertheless, China has dealt with the virus extremely well, and their CNYA is growing in strength. Also, Euro USD, you see it right before you. USD CNY, Chinese Yuan. That's Chinese. I think it should be. It's RMB. We're domestic. Chinese domestic, and CNYA is Chinese export currency. A weakening dollar, as you see. What's my whole point? Might be time to get into some of these longer trends. It's still almost at its 52-week high. We're there. I'm gonna sum this up. Why I'm going here with this? What's that fairly? Okay. At the top, European company that most likely going to do extremely well in the future. Royal Dutch Shell will benefit from a stronger euro. And what surprised me about Royal Dutch Shell is this 52-week range. This is a good buy now. Let's see what the computer says. Yeah, I see that right now. I see that. This is a good buy now, Royal Dutch Shell. I'm gonna skip over that. We all know the dollar and what it's doing. And here's another one. Royalty Pharma, European, added that a while back. Not so much spectacular. Not a lot of meat on the bone for that guy. But let's go to the top. New edition. Pharmaceutical company. A lot of meat on the bone. your ability to get tons of shares to be able to manipulate your market position. I like those. I like those under $10, in between $5 and $10 low cap stocks. So I can buy a whole bunch of them and manipulate my share costs in case my timing's off. You can manipulate time and space with a lower price stock, not so much with a high cap at my income level. Maybe you're a bit different. Novice at 82, not much meat on the bone. You can go look up and see what they do. We'll take a look at the analysis though. Strong buy, I don't understand. Maybe they expected to break this 52-week high of 99. There's not a lot of meat on the bone for me, per se. If we go and look at the analysis, all these companies, European companies, are strong buys. No doubt. Here's another one added. Real quick, let's take RIO. Still yet another strong buy. Not much meat on the bone. What do they do for work? Mining company. The biggest European mining company. Just remembered, at the top of its range, it's sure doing better than any U.S. mining company. Nothing new there. I think we have a few new ones left. I added this, but there's no information on this. And I have to look up exactly what they do. These are sort of kind of these European companies. I'm still on that. Once again, strong buy profile. This is one of this global private markets investment management firm. Manages portfolios, international clientele. And private equity refers to investments made in private companies. Debt, which refers to debt financing for private corporations or projects, which allows investors to access investment opportunities that are not available in the public corporate bond market. Private real estate, which refers to investments made with private real estate assets, including a range of investment opportunities from housing complexes, office space, shopping, industrial buildings, private infrastructure made in private infrastructure assets such as transportation, communication, power, conventional power, renewable energy infrastructure, water, social infrastructure, and waste management. So these guys basically may be managing a portfolio of a company. Definitely with a volume. I can't even read that. Looks like 21 to me. 52-week range really blew me away. 535 to 933. 21 shares. I have to look at the dividend is $26. Hold on. Look at the market cap though. No one is this. You're looking for solid. I mean, you can't find it better than this. Look at the market cap, 26.05 billion. Oh, there's plenty of shares out there. I wonder. Let's see what we can do. I'm going to keep my eye on this and see really what this is about. No comments. No comment right now. I'm just looking at stuff. Credit Suisse, new one. And a little meat on the bone, little chicken tender there. Let's see what Credit Suisse is up to. Strong buy. Another European company, since we're on that deal. Credit Suisse is a financial service company. Swiss Universal Bank, International Wealth Management, Asia Pacific, that's what caught my eye. Global markets, investing in banking, capital markets, strategic resolution unit, and corporate center offers large range of private banking and wealth management solutions to its clients. My point in case. Wealth is moving from the public sector to the private sector. That's why we're here looking at this stuff. Now, if those private companies actually make their assets in some kind of way derivatable in the public arena, it could be a way to recoup some of your losses after they steal your Social Security retirement fund. It's strange. MSCI. This is another one of these European jobs. A strong euro. Using billions of dollars to sort of kind of get an edge in these European companies. I mean, it's only obvious. You have a European company going with a strong euro. You have a point now to where you can use weaker dollars to buy these companies. As these companies increase in value, at the same time, most of these companies are private, being publicly traded. I just think it's a good idea. I really think it's a good trade idea. I mean, that's just MFC. Is that something new? Man, Life Financial. And I'm thinking I need to move this. Life insurance. Your Canadian life insurance. What? Sci-fi banks. I guess life insurance can be included in sci-fi banks. We'll have to change the header there. Sci-fi banks, insurance companies, private wealth, manage. Let's leave it at that. Surprisingly, HDFC is sort of on the low. China must be like, forget these guys. Nothing's changed here. What's Dollar Tree doing these days? At the top. Getting close. Yeah. Look at that. Nestle was another one. Surprisingly, that's European. The top of the range. It says strong buy. I disagree with that. There's my UCO, as you see, looking nice. Trying to get into, another thing is to get into Aramco. Not public yet. Doing research on it. Did try to get into Wisdom Tree Gulf, which is Saudi or sovereign wealth. They got delisted. This was something I picked up not too long ago. 23, 52-week range, 28. Yeah, if you would have bought this and held it when I was raving about Air Lease, you'd be doing good right now. I just couldn't tolerate the wait. Nothing's changed there since we're just focusing on I held this for a while and it's still at 12. Didn't want to tolerate the deal. There's LI. I'm up in the pre, and that's the end of it. So I've said so much. I think you understand where I'm getting at. And just happy trading. Thank you for tuning in. What I would like to say is at the beginning of this year, I had a nice portfolio spreadsheet to present to you guys. Hopefully you read it. It's time to do another one. Definitely, this environment is forever changing and moving from super highs to coronavirus lows to stimulus highs to election time to who knows what's coming in the next few months. It's just the truth. It's time for me to start really taking notations from currently what I think is going on, and what the people I listen to, what they think is going on beyond the couple months. Some of the guys go day by day. Some of the guys go 6 months. They put something out, and I was planning on doing something yearly, but you can't. You can't. So what I'll end up doing is putting out a show of my last portfolio or trade ideas, and then back it up with another one um, as soon as it's completed, and it may be just one, just revise that one I've already created. Anyways, happy trading. Please like, share, subscribe. Please comment. Appreciate your time. Thank you.